Hello and welcome to the PPW podcast, bringing you news, views and interviews from the world of real estate, online marketplaces and PropTech industries. My name's Harvey Hancock. I'll be your host today. I'm news editor at Online Marketplaces. As always, we are with the indefatigable Simon Baker. I know you liked being described as that before. How are you doing today, Simon?
I'm doing very well. Do you swallow a dictionary or something? Indefatigable. Excellent.
Indefatigable. It's a great word, and
Yes.
we've got a few more great words coming for you this episode because earlier this year, Simon, we wanted to do regular news roundups. Never quite took off because life takes over, but there's been quite a lot of happenings in the industry in the last few weeks, so it's a great excuse for the two of us to get back together and just have a bit of a chat about what's going on around the world.
Absolutely. Let's jump into it.
So, where do you want to start? I mean, it's a financial season, so what do you reckon? Shall we have a quick word on CoStar and Hemnet?
Yeah, I think clearly let's have a chat about it. CoStar. So CoStar put out its 54th, I think it was,
That's the one.
consecutive quarter of double-digit growth. It did squeeze in with 11% across the line, so it is double-digit. And overall, it's actually, if you look at the business, great business, a lot of patience. I sat through the Andy Florence's earnings call, which was yesterday or the day before, and he even gave us a shout out, which was good.
He did indeed.
During the earnings call, so I've got to say thank you, Andy, for that. Overall, I think his underlying message is you've got to be patient. They're building up strong growth in the business, especially the homes.com business. So overall, great. The market, not so happy, down about 5% following the earnings call and following the performance. So if we sort of dive in a little bit, and you know what, I'm sort of dare I say it, falling massively in love with AI because I've taken the earnings call transcript and uploaded it to ChatGPT, asked a couple of questions, and lo and behold, I've got my key themes. Strong financial performance, 54 consecutive quarters. Their net income, so think of it as profit, was 53 million. So that was up from 7 million in Q1. So pretty good overall. No one's going to argue with that. With 700 million in revenues for the quarter. So well done to the CoStar team. Core business continues to do very well. Core business being their LoopNet type business, apartments.com and so on. A lot of time on the call was spent talking about homes.com and sort of, I think at the core of the questions of the analysts were, you're spending $1 billion on marketing to create, awareness, but where's the revenue, right? Show me the money, the results of doing all this. And a lot of the conversation was taken up with talking about the speed at which they're firing up their sales teams internally and some of the challenges they've got out in, I think it was Richmond, Virginia, I guess it is, in terms of, how fast they can hire people on board and so on. The underlying economics per person sounded great, but overall, there are a few issues there at the moment. That's why I think the market's sort of downgrade them a little bit, 5% off. But I think knowing Andy and the team, it's looking good. And they did an acquisition, I believe, Harvey.
They did a minor acquisition of what's the name of the acquisition? Do you remember off the top of your head? That's it. So it's like a lease management solution that has all kinds of nifty little bits and pieces that I'm sure is going to be. I mean, it's another step on CoStar's route to having an end-to-end.
Yes, they continue to build out a lot of stuff. I think the interesting thing is they also continue to look at acquisitions in Europe.
Yes, I mean,
team here. And what was interesting is, so let me finish. What was interesting is at the conference we had just about 3 weeks ago now, there's a strong contingent of CoStar people out here in Europe. So that was great, and I think it shows just how much they're focusing on this market and the opportunities that this market brings.
Absolutely. And the only other thing I wanted to mention was another quote from the earnings call is that with success in the US, our mission will be to expand globally. Obviously, last year, Andy said specifically we're looking in Europe. But I think the fact that he's changed the word Europe to worldwide basically means that this is a company that is genuinely on the lookout for acquisition opportunities in Australia, in Asia. I'm sure that they'll be looking around not just in France, Spain, Italy, Germany, but I think they're going to be widening their net. Hey?
Yeah, I think, so overall, CoStar is doing well. The market wants more, especially when you put your head out there and spend $1 billion. They want to see good results. Got to be patient. Andy, I think, reinforced that point 3 or 4 times on his earnings call. And, my view is that they've got a great track record. They've built a great $35 billion US business. Got a very good team, got a good little free cash flow coming out of the business, I think, and a very good war chest. So watch this space and be patient. I sort of agree with him. It takes a while to get momentum. And if you're especially in like a homes.com taking on the market leader, it does take a while to really deliver the results.
Absolutely. Another company that is...
Actually, speaking of delivering results or not delivering results, let's actually, before we go to Hemnet, let's go to Domain in Australia.
Okay, let's talk about Domain. Talk to me, Simon.
The other reason I'm going to talk about this is I had a long 1 hour phone call with some consultant types this morning on this topic. Well, this and related topics. So as of a couple of days ago, Jason Pellegrino, the CEO, has left the business. Probably fired would be the message I'm receiving. And the question is, you've got to say why, right? Why? He's been CEO for 6 or 7 years. The business. Well, I thought I'd do a bit of a quick analysis here. If you go back, so take the last 5 years since 2020. In the last 5 years, the Domain share price has gone from $3.18 to $3. It's gone nowhere. 6% decrease. Okay, so that's not fantastically good. In the same time, the REA share price has increased 108%. From about $109, $110 to $230. So if you're sitting there as Channel 9 in Australia, the owner, it's a listed company, but the majority owner is 9. You're scratching your head going, wait a second. So in 5 years, REA's doubled in value, and you've gone basically nowhere. And then you look at the underlying numbers. So Domain's increased revenues 25% and increased EBITDA 40% over those 5 years. REA's increased revenue 60% and EBITDA 20%, more or less. Okay, so you're going, wait a second, why? What is it? What is it that's occurred that's mean that Domain has fallen out of favor with the market, and REA is the golden child? And I think a couple of things are happening there. One is, in growing the business, a lot of that growth has come from acquisitions of ancillary products and services, but they've not really delivered all the results that were promised. So a lot of money has been spent. I don't have how much, but it's not chump change in that process. So if you're not delivering results by buying all these ancillary businesses and things in CRM, software products, and so on, you're probably distracted from the core game, and the core game is advertising. And what's happened is, yes, they've grown their revenue 25%. REA is up 60%. You would think that you would be pretty close to being on the same growth rate, especially given that your traditional strength as Domain has been in what we call the leafy green suburbs, the high value suburbs in Australia. You should have delivered very strong results by focusing on those suburbs. My guess is they've taken their eye off the ball, focused on the ancillary products and services. They've not delivered, and eventually the board's gone, you know what, I've had enough. Time for a change. And then the question is, what do you do? And I think what we should do is a separate podcast on that. Leave it as a bit of a cliffhanger for the moment, because I've got some very clear ideas on what should be done to turn that boat around and close the gap, right? Because through, I think, a few pretty obvious initiatives, you can double the share price.
Nice. We'll pencil that one in, and we'll maybe try and find a guest to come and join us and spar with you, Simon. Got any ideas for names who could join?
I've got a few names. Don't worry.
Good. It's a nice segue because another portal that's going to be looking for a new CEO is Hemnet in Sweden. Net sales up 37% to the equivalent of $35 million for the quarter. So this is a very strong business, right? But Celia Beck-Friis, one of few female CEOs in the portal world, has decided that after 6-7 years at Hemnet, it's time for a change. So, Simon, we've got a clear market leader, very dominant position. What is the profile of a CEO to come in and replace someone who's taken Hemnet all the way to the very top? There's not too far for it to go, is there? Are they already maxed out, and the CEO has to come in and just make sure they don't mess it up? Or is there potential for more growth and more exciting things coming out of Hemnet?
Well. Let's take a step back. If you're at the conference, we talked a bit about Hemnet. It was I think Malcolm Myers talked about Hemnet, and maybe Jonathan Turpin from the ANG Group. And what was interesting is they noted that when you look at on a comparative basis dominance of portals in terms of traffic, Hemnet outstrips everyone by a massive factor. The number 2 player was so far in the distance that you really can't see them on the chart. And what that's allowed them to do is leverage that market strength and roll out a vendor-paid advertising model. And that vendor-paid advertising model has allowed them to accelerate their revenue growth. And they've done an exceptional job at doing that. Clearly, people are going, wait a second, why don't we roll out vendor-paid advertising models in other markets? And the reality is no other market has the same structure as Hemnet in terms of dominance. Not the United Kingdom, nowhere. So therefore, it's a hard one to replicate. In terms of a new CEO, well, first of all, don't stuff it up. That's the first thing, right? You've got a bit of a rocket ship, and they've done a very, very good job at building that business. So you want to do a couple of things. One is keep driving it forward. Keep rolling out the vendor-paid advertising model to get to more of the market over time. Probably you'll, and I don't know the details about the business, but my guess is you're probably going to get more nuanced in how you do it, more price bands, more custom-based pricing based on location and capacity to pay and so on. So you're starting to really extract more value. And then you're really probably saying what are the legitimately ancillary products and services I might be able to get into in that market. Once again, it's not going to make a massive difference, but it does create some growth options, and it's probably best through acquisition rather through than an organic approach. So you need a safe pair of hands, someone with a lot of experience in what they're doing, someone who is confident in dealing with the market because it is a listed company. So you've got to have that good external stock market interaction, good relationship with shareholders, experienced in dealing with boards, experienced in dealing in more corporate environments. Not too entrepreneurial because you don't need to be entrepreneurial. It's now just constant growth for the next 5-10 years. Just keep 20-30% per annum. Just keep driving that growth and so on, and deliver good returns to shareholders. And then progressively look for acquisitive opportunities, maybe in the Nordics, but I wouldn't want to probably go too far because I think it just becomes a distraction. What's happening? So that's what I'd be doing. And that's what I'll be doing, and that's what the characteristics of a new CEO need to look like.
Could I take us back to Australia for a very quick moment?
Sure.
We've mentioned Domain, we've mentioned CoStar. It's hard to talk about Matterport without talking about CoStar now. And Matterport has signed an agreement with Homely, one of the challenger portals in Australia. Am I thinking too much into this, or does the fact that Matterport is taking an interest in Homely mean that CoStar could be looking at Homely as a potential acquisition target? You're shaking your head.
No. Well, it's Homely is very different to On the Market. Right. So On the Market was far more progressed. I think a far bigger player, and I think if I was going to make a bet, I would probably acquire Domain before I acquired a smaller player, because the amount you'd have to invest into the smaller player would be quite a large amount.
Okay.
And I think you could with Domain. Domain's profitable, right? So because it's profitable, it's making money, you could finance half the acquisition through some sort of debt facility and use a bit of equity to get a very good outcome. And so I'd start with Domain as an acquisition target before I went to Homely, because you're going to start so far further down the road. So no, I don't think this is a way in for CoStar. Remember, okay, CoStar doesn't own Matterport yet.
Yeah, but they must be having conversations with Matterport, and they must be keeping an eye on what kind of partnerships they're signing, because it's going to have an impact a couple of years down the line, right?
Yeah.
Maybe I'm wrong. I don't know. I'm just raising it as an idea.
You clearly want to make sure you don't annoy the regulators in the US. So
okay, fair enough.
I'm not aware of the law, but I assume that until you acquire them, you can't actually control them.
Okay, fair enough.
So I think, and honestly, I don't partnering with Matterport. So what? I don't think it's not a game changer.
Okay, fair enough. It was nice for a bit of gossip, but maybe not a serious conversation. There is a serious conversation though. Dubizzle Group, they want to try and float next year. We did an episode recently, Simon, the two of us, about going public. What are your thoughts on the Dubizzle Group going public, and what should we expect from this kind of flotation if indeed it does go ahead?
Well, first of all, the Ali Khan brothers, led by Imran as CEO, are incredibly good operators. Right, very good operators, very smart. They've been at this game for 15, 20 years. So they clearly want to start releasing value. So you can understand why. It used to be a Pakistani business with Zameen. Clearly, they've had some troubles politically in that country that's made that asset less valuable at the moment. Doesn't mean it's not valuable, just at the moment it's less valuable. And they've spent a lot of time building a very good business out of Dubai, and then operating in some other markets in the area. So good operators, good underlying business. My guess is that Property Finder would be starting to think about, wanting to release value as well through some sort of event like a listing. So I think going first is probably a good move. Okay. Could be a good move or a bad move, but I think it's probably a good move, because you're going to get, there's a lot of money in the region, especially coming out of Saudi Arabia, who will be interested in that sort of business. You'd probably list on the Dubai, the UAE Stock Exchange and so on. So I got a feeling that this is a good move, but it has been talked about for a long time. The other thing is, this is not new news, but if they do go from conversation to action, I think that'll be very good for them. And my guess is they've probably been spending their time cleaning up the group. They have sold off all the Lamudi assets. Which is about cleaning up the business, and they're very much focused on something that's easy to communicate, which is the Dubai market. So or the UAE market, I should say. So absolutely. I think it'll be definitely keep an eye on that one.
Nice. One other question before we move on. You said going public is all about scale. Scale. So how does the Dubizzle Group scale post-IPO?
I think you would take an IPO, and then if you depending on who your shareholders are so if you're dealing, let's say if you're on the Australian Stock Exchange, the shareholders want to see you do stuff in that Australian market, things that they can mentally get their head around. Okay. If you're in England, they are sort of looking at England/Europe doing stuff. If you're doing stuff at the other end of the world, as valuable as it may be, it sort of gets a bit discounted in the process through distance and lack of understanding. If they look at the where they're based out of the UAE, and they're looking at, well, what can I do in that region? There's lots of emerging markets that have super interesting businesses. I'd be going, looking for roll-up opportunities that strengthen your position and give you more scale. But in that region, the MENA region, Middle East, North Africa.
China, FangDD, they were warned that their shares were not valuable enough by NASDAQ last year. They just about regained compliance recently. They had to trade a dollar plus for 10 consecutive business days. The shares are barely holding on above that minimum compliance range. So I'm just trying to get an understanding of what that means internally for the business. Are they likely to be warned? Is this a 3 strikes and you're out kind of thing? Like, this is a company that has really struggled to retain value since the pandemic.
Yep. So let's talk about what it is. So if you're running a listed company, and I've done this before, and I've had this sort of challenge, if your shares fall, now each stock exchange has different rules. That's the first point. But a lot of them have to do with either liquidity. There's not enough liquidity in your shares, which means people can't buy or sell them. Because of that, we don't want you on the stock exchange. Because remember, what is a stock exchange? It's a business. And as a business, it makes its money on trading. So every time people buy and sell shares, they have a little clip of a ticket. There's a little fee that goes with it. Plus, you as a company pay fees for being listed. So when you're not trading, you're not making any money for the stock exchange. So keep that in the back of your mind. So the exchange, for many reasons, has rules, right? You've got to be of a certain size, a certain scale. Otherwise, you just sort of hang around like a bad smell, and it doesn't help anyone. So in this instance, your shares have to have a certain price per share, right? You can't be a penny stock. Otherwise, if you fall below, I think this is $1 in this case. Mm-hmm. If you fall below a certain level, what happens is you get a warning. Hey, can you improve your share price? Now, to a certain extent, you can't do much, okay, except perhaps do a 1 for 10 offer, which means that you consolidate your shares. So if the shares are at 90 cents and you do a 1 for 10 offer, you end up at $9 a share. Okay, so every 10 shares, we're going to reissue. We'll bring them down to 1 share and so on, and you get your share price up that way. Doesn't affect your overall market capitalization. The problem is then your share price keeps going down again, right? So you're delaying the inevitable, and so you have to really fix the core underlying part of the business. But they're not, FangDD is not the only one. There are other shares out there, other companies out there who are in this space and who are, struggling to keep their compliance. And the thing is, once you cease to comply, you'll then become delisted. And if you become delisted, getting relisted is a process. It's not like, here's $10 and you go back again. No, it can be a new prospectus, a whole range of things for the business. So not good at all, and probably just symptomatic on one of two things. Either A, the core underlying business is not great, or B, the market it's on just doesn't like them, right? And then maybe they're listed on the wrong market and it's time to move to another market.
There. PropertyGuru, a public company that's about to go private. The shareholders voted basically unanimously for a takeover. What are your thoughts on what PropertyGuru is likely to be able to achieve under private ownership? What can we expect from this kind of deal?
Yeah, well, no surprise here. Right, let's just cut through the crap. No surprise, right? The company had really gone nowhere. So it listed about the history, for those who are unaware, the potted history, is they were listed via a SPAC about 2 years, maybe 2 or 3 years ago. I can't remember the exact
I think
date.
it's 2.5. I don't think we've even hit 3 years yet.
Okay, right. And so when you do it via a SPAC, you start at a $10 share price, and they basically drifted down to, I don't know, what was the final price? $3 they got offered, and they'll probably
around 3 or 4.
Yeah, so they basically lost 80% of their value. someone said, well, wait a second, we're going to buy you off we'll make an offer to buy. They put in a pretty good premium, about 30 or 40%. And so if you're a shareholder and you're going, well, we've been trading on the NASDAQ, I think it was, or the New York, no, it must have been the NASDAQ. And we've been sitting at, a big discount to what we were when we were listed, when we went through the de-SPACing process. And therefore, we've got a problem. And that fundamental problem is, we're going nowhere. Management hasn't done a great job at building the business, or at least communicating the value to the stock market around how well the business is going. So a private equity firm's gone, you know what, I'll buy this. I'll offer every existing shareholder a premium, 40%, whatever the number is. And what happens is, if you're a shareholder, you're going to go, I'll take the 40%. Because otherwise I'm going to say, I think management can do a better job over a reasonable period of time. Okay, so no wonder they all voted to take it to take it private. They're going to take it private. They'll get their cash. The EQT, who bought it,
EQT
is going to rebuild the business, focus on growth. Now they have to deliver material growth to the business because, like all PE firms, they want to get 2-3 times their money. So they're going to work very hard over the next 24 to 36 months, probably actually a bit longer, probably 5 years, to build growth, and then they will sell it. All right, and probably bought by another PE firm as we do the PE merry-go-round, a bit like.
And so the cycle continues.
Yeah, or it'll get relisted on an appropriate stock exchange, right? And I don't think the SPAC process was a very good process. That wasn't a good choice. Okay.
You've mentioned SPACs a couple of times, and every time you mention them, I see you sort of cringe a bit. I don't think you like SPACs, shall we say? I'm guessing they're a complex, difficult beast to handle.
Yes, and I've been involved in a SPAC, right? And there's a very simple process. You basically create a cash box. So you go to a stock exchange, you have a sponsor. The sponsor then is the one that can make all the money or lose all the money. Okay, and you basically go to the market and say, give me your cash, I'll guarantee you a 1 or 2% return. Okay, which is great when interest rates are low. It doesn't make sense when interest rates are high. And it's a bunch of money sitting there. These SPACs are a couple $100 million, and you go hunting for acquisition opportunities. You hunt. Hopefully you find something, and then you negotiate with your target. You de-SPAC, and then you list on the stock exchange. Now, if you don't go through a de-SPAC process, then the shareholders say, give me your money back. You have like 2 years to do the job. And the sponsor then pays the interest and loses their money. Okay. If you go through that de-SPAC process and you find a company, and then what will happen is, you hopefully it flourishes and goes up, and everyone makes money. But if it goes down, then you lose money. But at least you haven't lost as much money as if you had not gone through the de-SPACing process in the first place. So yeah, it's something that was a fad that occurred, came and went. That's the way I think about it.
Yeah, and hopefully there won't be too many more, I'm guessing.
It's not a hopeful thing. It's just a case of whether there will be or won't be, right? And that's just a function of the market dynamics, interest. But it's primarily a function of interest rates. Okay.
Fair.
Otherwise, people will go through the normal process of listing a company, and away they go.
That's pretty much all the big news that's happened in the last month or so, Simon. Is there anything that you've spotted that you would like to add?
Yes.
Tell me.
I've been having some very good chats with a guy called Malcolm McCallion out of United Kingdom. Model Prop, and we've been having some very good conversations around the future of real estate advertising, the role of AI in that future, and what it really means for property portals. And so I think what we'll do is we'll do a podcast probably in the next week or two talking about that. He and I are of the same view that maybe, means maybe property portals have reached their zenith, and we might be starting to see the potential decrease in property portals because of the AI-driven technology and how that puts the power of marketing back into the hands of the real estate agent. I'll leave that as a cliffhanger for next week, and I think that's going to be a very interesting topic. A couple of things I want to mention, Harvey, before we leave. 2 conferences coming up. We have the Bangkok conference coming up on the 12th, 13th of March next year. Bangkok at the Carlton Hotel, same location as last year. We'll have 200 people. We've got good 30 odd people already registered, interesting companies. So this is already, and we're way ahead of where we normally are in this process. And we're actually even started advertising our European conference, which will be 51 weeks from today. So about the 14th or so of October next year in Madrid. So you can sign up today, get the cheapest tickets possible if you want to come. The one we just had was an absolute blast. People really enjoyed it. Great conversation, great topics, and great speakers. So I just want to encourage everyone to register, and we'll see you at one of those conferences. And we may be doing one in Mexico City, or that the jury is out on that one.
Okay, fair enough. And we had a good interview with Matthew Page from Ringier this week. That should be coming out next week, ladies and gentlemen. Usually we try and reserve half an hour, but that one stretched to 45, 50 minutes, and there's a reason, because very interesting business, Ringier, and sort of a hub of technology and software purely for classifieds businesses around the world. So some really interesting insights coming out of Ringier.
Yeah, and actually what's interesting is how they're using AI to streamline processes, to reduce the reliance on some people in the operations, and to achieve much greater results. And the thing is, it's available for everyone. So tune in, listen to that, and you'll enjoy the outcome.
Perfect. Couple of small things from me. One, we are still uploading videos from the Barcelona conference. We are now on to the afternoon of day 2. So we've got about half of them, 2/3 of them online now. They are private for now, so don't ask, because you're not going to get them yet, but they are coming. And a teaser is that there may be a nice, interesting, exclusive interview with online marketplaces coming in the next month or so with a well-known portal brand. Another teaser, another cliffhanger for you, but some good stuff in the works. Simon.
Yes, always interesting. Thanks, Harvey. Good to have a round the grounds today, and we should do this again next week.
Absolutely, sounds good to me. Until next time, it is goodbye from Simon Baker.
Yeah, it's goodbye from him.
And it's goodbye from me. Goodbye.